The biggest company in the world, Apple. This tech juggernaut has revolutionized the world with its iconic products, from iPhone to iMac to smartwatches and even services. Apple's rise to prominence didn't happen overnight. It was built on a foundation of innovation, design excellence, and an unwavering commitment to creating products that captivate hearts and minds. From its unrivaled brand image that commands loyalty like no other to its cohesive product ecosystem that seamlessly connects devices, software, and services, Apple's strengths are the pillar upon which its empire stands. In this video, we will go through some Apple financials, valuation, and SWOT analysis. Let's dive in. This $2.70 trillion company that is trading at $171.69 per share at the time of this recording is an absolute cash machine. For a company of this magnitude to be generating a growing revenue of $394 billion with a 9.5% year-over-year is beyond crazy. This is reflected in their EBITDA and net income as well. Having an EPS of $6.50 is tremendously good, and they have an adjusted free cash flow of $102 billion. Back in the days, investors would say that Apple was overvalued and that they couldn't continue to grow. They were all wrong. Apple is the biggest company in the world right now, and they're extremely profitable. When we look at the cash balance, they have a net debt of $51 billion, which is not alarming due to the amount of cash flow that this company generates. Apple can fully pay their debt, but they just prefer to use that cash on capex, dividends, or buybacks. Taking a look at the margins just to further prove that Apple is a cash flow machine, profit margins, which is how much of every dollar in sales the company keeps from its earnings, is currently sitting at 24.50%. While the operating margin, which is how much revenue the company keeps after the deduction of operating expenses, is 29.20%. Quarterly earnings year over year is presented as 0%. This is because it's unchanged. Same value as previous year. Now, for the quarterly earning, we are down 3%. Consumers are holding a bit on spending in reaction to a recession. The forward P of Apple is sitting at 29.15 compared to the 5-year average of 24. Apple seems expensive. In my perspective, for a company of this magnitude, the PE is correct. This is the biggest company in the world, is beating the market, and it returns value to the shareholders. So, of course it will have a premium. It's more expensive than the market and other big tech companies like Microsoft and Google. Valuing some components of Apple, starting with the PE growth, we can see that Apple is overvalued. 2.33 PEG is expensive. Typically, we want the number under 1 to consider it undervalued. Looking at the ROCE, Apple has 60%. Yes, this is not an error. 60% ROCE. That is extremely good. The company simply makes money, and that money generates more. Looking at the discounted cash flow based on a 10-year period, Apple's average free cash flow growth rate is 12.12%. Using this assumption of 2.5 perpetual growth, a conservative free cash flow estimate of 9%, and a discount rate of 10%, we get the fair value of $136.04. This does not include a margin of safety. So that's something that you will have to do for your calculations. $136 per share seems reasonable for me, but also keeping in mind that this is a tech consumer staple company that has the cash flow and brand value to continue creating products or services that the consumer will need. Apple is working on its own vehicle and also entering the healthcare sector. Those are things difficult to calculate in a discounted cash flow. That's why it's important to run several numbers. Now, this is the reason why I also like to do a SWOT analysis, because aside from numbers and statements from the company, you can visualize the strengths and weaknesses of a company and add a bit of reasoning to your investment choices. When we look at the strengths of Apple, we see a strong brand image. Apple is a world-class company and their logo is recognized everywhere. A lot of people use their products and the loyalty for the brand is big. Apple offers a comprehensive ecosystem of devices and services where they integrate with each other, locking in the customer and maintaining user retention. This retention is reflected in the financial performance of the company when you lock in the customer plus acquire new ones. This is shown as a constant buy for the products of this company. Think about it, once in a while customers in the ecosystem will like the latest iPhone or the latest watch, while consistently paying for Apple Music or any other subscription solution. The cash flow just keeps flowing in. A company as big and profitable as Apple does not mean that it's indestructible. Like any other company, it does have its fair share of weaknesses. Apple revenue relies heavily on iPhone sales. However, Apple has invested a lot on their software side like services, and it has increased over time. It's not enough to beat the revenue that iPhone brings, putting the company in a somewhat vulnerable situation if the iPhone loses market share rapidly. We have to keep in mind that quality comes with a premium, and Apple brings quality. Apple products are expensive compared to the competitors. This increases the profit margins, but at the same time, it reduces the growth in a price-sensitive environment. Apple outsources the creation of some component of its products, putting a concentration risk and dependence on suppliers for their items. Geopolitical situations or supply chain disruptions could put a big dent on Apple profits. Now, while the software ecosystem is a strength from a different perspective, it could be a risk too. It could limit compatibility with non-Apple devices and software platforms. Knowing both the strengths and weaknesses of a company allow us to brainstorm and look for ways on how to improve. Service growth is a strong contender when it comes to growth. Either existing or new ones, Apple can capitalize by the continuous expansion to attract more subscribers. It can work as a complement to revenue in case of the iPhone sales decline. As mentioned, Apple brand is a recognizable brand worldwide, but this does not mean that everyone uses their devices, giving Apple the opportunity for emerging markets and increasing their user base. While Apple continues to innovate and create more devices, they have to come up with extra ways of environmental sustainability. Recycled items, less packaging, more effective distribution, and the list goes on. Then we have threats. Apple faces intense competition. In every single product or service, they have a competitor offering a cheaper alternative. This puts Apple in the position of constant innovation so they can maintain their market share. While the innovation must continue, they also could face intellectual property infringement. While most of their creations are under a patent, competitors could create a similar alternative and erode Apple revenue and reputation. Infringement could also happen if Apple accidentally copies a patented product, but that's highly unlikely. Apple operates in different business models, putting the eye of the government on them. Changes into privacy, data protection, and antitrust could impact the company. Another legal challenge will be if the government will stop acquisitions. This prevents Apple to becoming a monopoly. So there you have it. This is my video for Apple. I do own the company and it's one of my largest holdings in my portfolio. It's been a while since I have purchased any shares since valuation seems a bit stretched. But I do have dripped on, so besides unrealized capital gains, my holding keeps growing due to dividends. Hope you enjoyed this video. Thanks for watching and till next one.